Welcome to the Investment Dive, brought to you by Corporate Capital Market Limited. Joining you today are your hosts, Amanda and Adrian.
Welcome back to the Deep Dive. Today we're digging into something really vital, especially if you have connections to Sri Lanka, planning for retirement security. You sent over some really insightful material focusing on planning for security and dignity over there. And the core idea, well, it's a bit stark, isn't it? The old way, the family safety net. It's just not holding up like it used to. So our mission today, as we, unpack this, is really two things. First, figure out why that traditional setup isn't working anymore. And second, pull out the real practical steps that, honestly, everyone should be thinking about now to make sure they can age with dignity.
That really is the heart of the challenge. We're seeing these profound socioeconomic shifts, demographic changes.
Right.
Things are moving fast in Sri Lanka. For generations, the assumption was just, well, your family takes care of you in old age.
Right.
But the research is clear that's no longer guaranteed. Personal planning, it's moved from nice to have to absolutely essential.
Okay, let's start right there then with that changing social fabric. The old model, it was based on, well, having lots of kids, extended family, everyone living close by, right? Ready to step in with help, emotional support.
Exactly. Proximity and numbers.
But today, it's just totally different. Family sizes have shrunk dramatically. You see lots of families with maybe one child, sometimes none. That completely changes the math, the whole foundation of that old support system.
It does. And you have to layer migration on top of that shrinking family size. What's fascinating here is just how quickly this centuries-old way of life has weakened.
Yeah.
Young professionals, they chase jobs, education, often overseas. And critically, many end up settling abroad permanently.
Right.
Now, the emotional connection, that stays strong.
Yeah.
Kids often want to help their parents back home. But the physical distance, it makes that daily hands-on caregiving almost impossible.
So that decline in family support is really the first big reason why planning is now so critical. Okay, but let me push on that a bit. We know remittances, the money sent back home, are massive for Sri Lanka's economy. So if the kids are overseas but sending money, doesn't that solve the problem? Can't that buy the care needed?
That's a really important question. And the short answer is not completely. Remittances can certainly help with, regular bills, maybe hiring some help.
Okay.
But they can't really replace the care itself. Think about it. Who manages the caregiver? Who makes urgent health decisions if something happens suddenly? Who provides that immediate emotional comfort when someone's frail or ill?
Yeah, I see.
If you need daily help and your child is thousands of miles away making frantic calls, it's just not the same. The day-to-day burden, the coordination, it falls back on the parents themselves or maybe a remaining relative who might be overwhelmed.
So the money helps, but it doesn't fill the gap left by physical presence.
Exactly. Which means having your own financial resources enough to pay for reliable nursing, suitable housing, unexpected medical needs becomes non-negotiable. You can't rely on someone else managing it remotely long-term.
Okay, that makes sense. The reliance shifts from physical closeness to, well, financial independence. And that leads us straight into the next big challenge, which kind of ironically comes from a success story. People are living longer. Sri Lanka's healthcare improvements mean life expectancy is up, over 77 on average now. Many people are living well into their 80s, even 90s, which is fantastic. But here's where it gets really interesting, financially speaking.
Right.
Retirement isn't this short little break anymore. If you retire around, say, 60, you could easily be looking at funding 25, maybe 30 years of life without a salary. That's almost as long as a career.
That duration changes everything. It completely reframes the financial task. You might hit retirement age with what feels like a substantial amount, from your EPF, your ETF, maybe your gratuity payout.
Maybe quickly explain those for listeners less familiar.
Sure. So the EPF Employees Provident Fund is like a mandatory savings scheme. Employers and employees both contribute. The ETF Employees Trust Fund is another benefit fund. And gratuity is typically a lump sum paid when you leave a job after a certain number of years. These are sort of the traditional pillars for formal sector employees.
Got it. And the danger is thinking those pillars are enough to last potentially 3 decades.
Precisely. They often won't be, not without careful management and, frankly, supplementation. And this is where inflation risk becomes a huge problem.
Inflation.
Yeah. Sri Lanka's seen periods of really high inflation. Even if you assume a more average rate, say 7 or 8% a year, compound that over 20, 30 years. It absolutely decimates the purchasing power of a fixed lump sum. What looked like a comfortable nest egg today might barely cover your needs 10 years into retirement, let alone 20 or 30.
So the money just vanishes in terms of what it can actually buy.
It shrinks year after year. And then there's the other big elephant in the room, healthcare costs. The research clearly flags this as probably the single biggest financial threat in retirement.
Right.
As we age, chronic illnesses become more common. Diabetes, heart issues, maybe cancer, needing long-term care or expensive treatments. These aren't one-off costs. They can be continuous, and they can wipe out savings incredibly fast.
And crucially, the sources point out something important here. Unlike some other countries, Sri Lanka doesn't really have a widespread, affordable, government-funded system for long-term elder care, right? Or comprehensive state pensions for everyone.
That's a critical point. That safety net, it's just not there in the same way.
So we often hear politicians talk about improving state care, maybe expanding facilities. But your point, based on the sources, is that listeners shouldn't rely on that promise for their own planning.
That raises an important question about risk, doesn't it? While everyone hopes for better state support, basing your personal retirement security on a future political promise that's very risky.
So,
Well, government budgets change. Priorities shift. Funding gets reallocated. And even if more state facilities are built, will they be the quality you want? Will they be located where you need them? Will there be enough capacity? The reality, as highlighted in the material we reviewed, is that there are significant gaps in institutional support right now. So the responsibility falls primarily on the individual. You have to be your own safety net, essentially.
which brings us back to why we're having this conversation. It's not just about money, is it? It's about dignity, independence.
Absolutely. Financial stability in retirement gives you choices.
Yeah.
It means you decide where you live, how you live, what kind of medical care you access. You maintain control.
Okay, so let's recap the drivers here. We've got the decline of the traditional family support system, people living much longer,
Right.
potentially devastating healthcare costs,
A big one.
and the quiet erosion of savings through inflation. Those are the big four, pushing the need for personal planning. And I think we shouldn't underestimate the emotional side either. You know, that feeling of not wanting to be a burden on your children, especially when they're likely juggling their own finances, mortgages, kids.
That's huge. There's immense emotional relief for both parents and children when parents have planned properly. It allows the relationship to stay focused on love and support, not financial stress or obligation.
It preserves dignity, like you said.
It preserves dignity, self-assurance, and family harmony.
All right, this feels like the perfect point to pivot to the solutions. If personal planning is so crucial, what does the secure retirement toolkit look like? What are the actionable steps the source material lays out? Because as you said, putting this off isn't an option.
No, it really isn't. And the most powerful tool you have, truly, is time. Starting early is paramount. So, step one, start early. We talk about compounding, right? In the Sri Lankan context, with potentially high inflation, starting in your 20s or 30s is crucial. Even small amounts, invested consistently, have decades to grow and hopefully outpace that rising cost of living. Time magnifies your efforts.
Okay, start early. Makes sense. Step 2, diversify your income sources. This sounds like a direct warning against just relying on the EPF, ETF, and gratuity.
It is. Relying solely on those state-linked funds is risky. Why? Because regulations can change, payout rules might shift, and frankly, the returns often struggle to keep pace with real inflation over the long haul.
So what's the alternative?
You need other pillars. Think about things like building a private pension plan, maybe investing in rental properties for steady income, or looking into annuities. The goal is multiple streams, so if one underperforms or changes, you're not left high and dry.
Right. Don't put all your eggs in one basket. Step 3, invest for growth and protection. This isn't just about saving in a bank account, is it?
Absolutely not. Just letting cash sit there means inflation is actively shrinking its value. You need to invest, but strategically.
What does strategically mean here?
It means balancing things. You need some assets geared towards growth, maybe carefully chosen local stocks or real estate, things that have the potential to grow faster than inflation. But you also need stability and protection. Maybe government securities like treasury bills or high-quality corporate bonds, which are generally safer.
And that mix changes over time.
Yes. Typically, as you get closer to retirement, you'd gradually shift the balance more towards those safer protective assets and less towards the high-growth, higher-risk ones.
Okay. Step 4, plan for healthcare early. We know it's a huge cost. What's the concrete action?
Health insurance. Get it early when you're younger and healthier. because the premiums will be significantly lower. And don't just get any policy you need to really look at the details. Does it cover chronic conditions? Does the coverage continue into retirement? Does it cover hospitalization adequately?
So read the fine print.
Definitely. Don't wait until you're older or already have health issues, because then it might be unaffordable, or insurers might exclude pre-existing conditions.
Got it. Step 5. Account for inflation. This seems related to step 3, but it's listed separately. Why?
Because it's a specific mindset you need for all your planning. It's not just about growth, it's about actively seeking out investments or products designed to combat inflation.
Like what?
Look for things where the return or the capital value is explicitly linked or indexed to inflation or cost of living indicators. This ensures your money maintains its real purchasing power over those 2 or 3 decades you might be retired. It's about protecting what you've saved.
Makes sense. And finally, step 6. Get professional advice. Some people might think they can manage this themselves.
And that's often a mistake. Retirement planning gets complicated fast. You're dealing with investments, yes, but also Sri Lankan tax laws, maybe inheritance considerations, understanding the local economic forecasts.
It's a lot to juggle.
It is. A qualified, certified financial planner can help create a tailored strategy that fits your specific goals, your risk tolerance, and navigates that complex, ever-changing local landscape. Trying to DIY this level of planning can lead to costly errors.
Okay, so those are the 6 steps. Start early, diversify income, invest smartly, plan for healthcare, beat inflation, and get professional help. So what does this all mean for you listening? The sources are really clear. Planning for retirement isn't some far-off luxury anymore. It's essential for self-preservation, really. It's about securing your freedom, your independence, your ability to age peacefully and with confidence.
Exactly. We need to shift how we think about retirement. It shouldn't be seen as just stopping work. It should be a new chapter, right? Full of possibilities, maybe travel, new hobbies, time with family, enjoying the life you've worked hard for.
Absolutely. So the message is urgent, really, regardless of your age. Whether you're just starting your career, midway through, self-employed, or nearing retirement if you haven't started planning actively. The time is definitely now.
And if the goal is to live that next chapter with ease and freedom, not anxiety and dependence, maybe the question to leave you with this week is this. What's one specific, concrete step? Maybe looking into that health insurance, maybe making that first call to a financial advisor, maybe setting up a small regular investment. What's one step you will take this week to start securing your own future dignity and independence?